With more on today's trade. Leanne, thanks for joining us. Talking markets, because it's not looking too pretty on the Australian share market right now. We're down about 0.7%. Bit of mixed moves, though, in the energy and the miners today.
Ingrid, that's exactly right. Seeing some mixed moves. A similar performance really to what we saw yesterday. Obviously that materials sector is still continuing to weigh. We saw a lot of those miners over in Europe really taking a hit, the likes of Glencore, Anglo American, BHP and Rio as well. So not surprisingly, we're seeing our materials sector under pressure, seeing those copper prices plunging to those 6-year lows. But also we saw iron ore pulling off as well as nickel. So some of those commodity prices as well. As you say, they are on the energy side of things. Still seeing that actually holding up quite well, despite still seeing those oil prices hovering around those low levels. Again, I think investors still finding a bit of support and some good buying opportunities at these levels. But as you say, the market really under pressure in early morning trade today. Obviously taking on from those negative leads we've had from Europe and of course Wall Street overnight. Really a number of concerns I think they're weighing. The World Bank cutting its growth forecasts. As I mentioned, those copper prices plunging, having an impact, and of course those December retail figures actually missing expectations over in the US. So certainly all of that translating across onto our market in early morning trade today, and certainly seeing it under pressure. It is looking like we're on track for the 4th consecutive day of losses. So it's obviously going to be a big focus on those employment numbers, which are out very shortly, expecting a rise of about 5,000 jobs, and of course that unemployment rate remaining at about 6.3%. And in our mind, the big focus will be particularly on the outlook for some of those non-mining sectors, so infrastructure and of course housing as well. So that will be a big focus, but unfortunately seeing it under a bit of pressure.
Let's focus on the resource space as well, more broadly, because we've got some production results coming out. Leanne, Iluka production report. What did you make of that one?
Ingrid, look, if we look at some of those numbers over 2014, obviously it did look a little bit weak. Those production numbers down 15%, revenues down 5%, and a result of continuing weak prices. But it does look like they may have had a stronger finish to the year, particularly in terms of those mineral sands revenues. If we look at their September quarter, we actually saw those revenues down about 30% or so, and that was a result of some of the timing of those rutile and synthetic rutile shipments. But we actually expected that we would start to see those shipments flowing through in the December quarter, and that would lead to a stronger finish to the year, and that's exactly what we have seen. Those revenues over the December quarter were actually up 58% from the previous quarter. So that certainly looked very positive, but I think seeing investors reacting to those overall 2014 numbers, which certainly did look fairly weak. If we look at some of those highlights, those rutile and synthetic rutile prices did look like they remained relatively stable for the most part of 2014. And also if we look at those zircon sales, they certainly were on trend, and we did actually see an improvement on each quarter, although they were still below 2013. So I think there is still a bit of a concern about the demand coming out of Europe, particularly given those deteriorating business conditions and of course the euro, and of course some of that demand coming out of Asia also remains relatively subdued. So I think the outlook for this stock still looks a little bit cautious, particularly in terms of those weak prices. As we know, it is very highly leveraged and closely tied to obviously building activity. So that is certainly looking a little bit wobbly coming out of the US and Australia, and I certainly think in terms of the outlook it is probably looking a bit cautious, and certainly seeing that share price under a bit of further pressure today.
More broadly, in terms of the way energy looks moving beyond sort of just, the short-term indecision by many of these companies as to whether they will even cut capex, because we've had the likes of Shell making headlines even overnight saying, look, a lot of the spend can be put on the back burner. Why do you think it takes Woodside so much longer, given its size? I mean, if Shell can work it out, why can't Woodside?
It's certainly quite interesting, Carson. Interesting that we haven't heard too much out today in terms of the impact of those oil prices. Obviously, we know it has been under significant pressure. It's been about down 20% over the last 6 months or so in the wake of those falling oil prices. But we will obviously hear more detail out around in terms of their spending plans and, of course, the impact on their profitability in February. So, as you say, interesting that it is taking them a little bit longer in terms of assessing that impact. But overall, I think, you know, they are continuing with a lot of these growth plans, as we know, you know, focusing on a number of exploration permits that we've seen coming through over recent months, and of course the purchase of those Apache interests back in December last year. So nonetheless, we do quite like the fact that they have taken a very disciplined approach in terms of these new opportunities, particularly after that Leviathan deal obviously was terminated, and also that Shell buyback fell through as well. So certainly like that side of it, but it will be interesting to see how they are going to be dealing with these weak oil prices. In our mind, we certainly do expect they will remain relatively weak over the short to medium term, and obviously that will continue to have an impact on that share price.
Yeah, lots to watch there, Leanne. We will leave it there.